Global output growth slowdown is over, but re-acceleration is slow. Global growth is forecast to increase 3.3% or $2.46 trillion to $74.15 trillion, with emerging market economies contributing 75% of that growth. That is lower than the 121% contribution in 2012. BRICS: Brazil, Russia, India, China and South Africa are forecast to contribute 22% of global GDP in 2013. China alone is expected to contribute just over 12.2%. The BRICS are likely to produce around 48% of global GDP growth in US dollar terms in 2013. US annual GDP growth in the first quarter of 2013 rose 2.5%, less than expected. However, the US GDP was changed this quarter to include intangible assets. Consumption continues to be the main growth driver. Artificial, ultra-accommodative advanced monetary policies persist in 2013. Japan is using liquidity to override fundamentals. The country has been on an unsustainable path of yen strength and deflation over the last 8 years, and so desperate times call for desperate measures. Why is economic stagnation, as is the case in Japan, a problem? Economic stagnation in any economic system, especially a capitalist one, matters because the distribution of national income does not remain static even if aggregate economic activity does. Even with no economic growth, currency shifts alter the competitive boundary of industries. Depending on company responses, this can undermine real wages and the composition of its workforce, resulting in an erosion of living standards. Government did not sit on its hands but tried on many occasions unsuccessfully to re-stimulate the Japanese economy, which massively increased national debt. The new Japanese Prime Minister, Shinzo Abe, has initiated massive policy intervention to spur a new, hopefully more sustainable growth path for Japan. He indicated that 3 policy arrows will be aimed at the economy, targeting moderate inflation and sustained positive real economic growth. One arrow is the major easing of monetary policy and acceptance of a 2% inflation target. The second arrow entails further fiscal expansion, and the third arrow is a program of supply-side reforms to spur private sector investment and growth. The much lower fixed interest asset returns in Japan in the months and years ahead are going to force investors like insurers to look for higher yielding assets to meet their liability-based yield targets. This probably means that they will track indices such as the World Government Bond Index. If this happens, high-yielding economies such as South Africa could see increased capital inflows. The result could be strengthening currencies in high-yielding economies. Currency strength would undermine their exportability and cheapen imports. Cheaper imports could boost consumption, despite already high household debt levels in South Africa. The central banks in high-yield economies would find it difficult to raise interest rates, as it would only attract further Asian capital. The sharply weaker yen will boost the competitiveness of Japanese exports at the expense of its main competitors, China and South Korea. This could slow the growth profile of Asia in the short term, undermining commodity demand. Movement of commodities to become increasingly uncorrelated. Signs of weakening industrial production in China and Germany, the world's largest exporters, have created a weaker tone to base metal prices. Concerns over Chinese steel market slowdown are pushing coking coal prices down to around $130 to $140 per ton. Another factor which could restrain price improvements looks to be increased domestic coal production in China and Australia. OECD leading indicators, LEIs, are improving but modestly. The latest LEIs to Feb 13 are creeping up in the advanced economies. The G7 LEI is up 0.46% over the last 3 months. The US is up 0.49%, OECD Europe is up 0.30%, and Japan is up 0.80% over the same period. BRIC LEI growth year-on-year is mixed, with China's LEI up 0.56% over the last 3 months to Feb 13, India down 0.84%, and Russia up 0.23%, and Brazil flat over the same period. Production side of the South African economy under severe strain. The productive side of the South African economy has been under severe strain over the past year, due mainly to production disruptions caused by wildcat labor strikes. The productive part of the economy comprises agriculture, forestry, fishing, manufacturing, mining, and construction and utilities. During the last week of April, the National Energy Regulator of South Africa, NERSA, indicated that it would not allow national power utility Eskom to continue with its costly electricity buyback program, as it expects the power utility to have excess capacity by 2019-2020. Interesting short-term logic. Eskom implemented electricity buybacks by paying a large user, such as metal smelters, to stop production so that it can supply energy to other users. In the winter months, many energy-intensive users reduce demand by shutting down smelters and plants in response to higher winter peak load tariffs. Regardless, ending the buyback program can be expected to place extra strain on Eskom's ability to keep the lights on this winter and next. Eskom warns of possible power outages this winter, but no load shedding is scheduled. Forced maintenance work and NERSA's decision not to allow Eskom to buy back power from heavy users, such as smelters, increases the probability of blackouts. The productive side of the South African economy is enduring a tough time at present. Manufacturing companies face increasing competitiveness from the outside from developing economy manufacturers with massive economies of scale. They also have to contend with disruptions to the supply of materials and logistics. To add to this, government is shifting its development policies, and the labor industry is becoming increasingly unmanageable. Investment ideas. Diageo plc. Diageo plc is a global alcoholic beverages company headquartered in London, United Kingdom. It is the world's largest producer of spirits and a major producer of beer and wine. Its brands include a few of the world's largest selling products, namely Smirnoff, the world's largest selling vodka, Johnnie Walker, the world's largest selling whiskey, Jose Cuervo, the world's largest selling tequila, Baileys, the world's largest selling liqueur, and Guinness, the world's largest selling stout. It also owns 34% of Moet Hennessy, which owns brands including Moet and Chandon, Veuve Clicquot, and Hennessy. It sells its products in approximately 180 countries and has offices in 80 countries. Its primary listing is on the London Stock Exchange, and it is a constituent of the FTSE 100 index. It has a secondary listing on the New York Stock Exchange. During its third quarter results presentation in April 2013, the company reported net sales growth of 6% for the 9 months to 31 March 2013. The US spirits business again delivered strong performance. Despite consumer weakness in 3 markets, namely Korea, Nigeria, and Brazil, performance was still in line with expectations.